Hey soldiers, Jerome Powell, Fed chair, is out there telling you point blank in Fed speak that he's going to raise the unemployment rate. Now, why do you need to know this? Look, if you are a small business owner and you got employees, you might be put in a regrettable position very soon to come to people and tell them they're laid off. Or you may be an employee that may be facing a layoff in the near future. Now, I certainly hope not, but I always want you to know where you are in the water. So let's just jump right into this. The Fed came out and they made some remarks here lately, and they basically said that, look, what we have to do is probably going to end up in layoffs and a tighter labor market. And really, that's what we are engineering here. They want to slow down this economy, okay? So they made money more expensive. So businesses are going to be put in a position where if money's more expensive, credit's tighter, demand's going to fall. And when demand falls, you don't need as many employees. You got to insulate yourself. If you are out there working right now, if your business is pulling in revenue right now, listen, a rainy day is coming. Okay, now is it going to last forever? Absolutely not. But you need to be in a position where you are the ant and not the grasshopper when the winter of this economic discontent occurs. All right, so the Fed, Jerome Powell, this is straight from the horse's mouth, so to speak. He's saying that currently the unemployment rate is at 3.7%. Now, let's examine that for a minute. All right, we've talked about it before. The Bureau of Labor Statistics comes out with several different stratifications of unemployment data. Now, it looks like Powell is talking about the U3 or the U4 rate, which are at 3.4 and 3.6 respectively for October of 2022. Now, the broadest measure of unemployment, the U6 rate, is at 6.3%. All right, so this is what you need to understand when you're looking at these numbers. The surveys that they're doing to come up with the number that they don't like reporting the total number, that U6 rate, because that is a higher number. So the government, the media, they all, Democrat, Republican, doesn't matter. They like to report the lower number, which is the U3 or the U4 rate. All right, so let's continue. Powell says that the unemployment rate is 3.7%, U3, U4, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 million job openings for every person looking for work. Keep that in mind. So he's saying so far we have seen only tentative signs of moderation of labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of 2022 to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time. Now, what is he saying? Well, this society needs to be able to create a certain amount of jobs in order to have a sustainable, ongoing economy. And he's saying that we're not only creating the amount of jobs necessary to do that, but we are exceeding that amount tremendously. But this job growth remains far in excess of the pace needed. He's saying that pace is at over 100,000 jobs per month over and above what we need. Job openings have fallen about 1.5 million this year, but remain higher than at any time before the events of 2020. All right. And apparently the Fed is not happy with allowing those job openings to continue to gradually fall. They're going to accelerate this. Now here's something you got to hear. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. So look, he's saying, look, wage growth is over 2%. But wage growth is not 8%, it's not 9%. These are the inflation rates that we've seen in general over the past 18 months. And food inflation is higher than that. That is the part of the economy you interact with the absolute most frequently. So the Fed's out of touch here. He's looking at this in purely clinical, analytical ways and not understanding. See, he's not going to the grocery store with you. He's not visiting the Kroger, the Piggly Wiggly, or whatever it is that's popular in your neck of the woods. And he's not seeing that when you get that paycheck or that commission check, okay, that number's down here and the grocery bill's up here. So he's talking about wages are over 2%. Big whoop. But he's not talking about that gap that still remains between inflated prices and your real wage. To be clear, he says, strong wage growth is a good thing. I would agree. But for wage growth to be sustainable, it needs to be consistent with 2% inflation. This is a quote. For wage growth to be sustainable, it needs to be consistent with 2% inflation. How out of touch is he? He's still talking about inflation as it existed in a world years ago. All right. And here we are now. So the Fed is not doing things that are in line with the expectations one might have to benefit the average American, the wage earner, the small business owner. Okay, so what does the Fed actually need to see for inflation to be 2%? We're a long way from that. Let's sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. They say growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Slow growth needs to be sustained. That's what the Fed is saying. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well. And this too must continue. Hopefully that will continue. He's saying that those bottlenecks have caused a supply-demand imbalance. So the demand is there, but the supply is smaller than the amount needed to satisfy demand. So prices naturally are going to increase. Housing services inflation will probably keep rising well into next year, but inflation on new leases continues to fall. We will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, shows only tentative signs of rebalancing. So he's saying that job market is still a big concern of his, and wage growth remains well above the levels that would be consistent with 2% inflation over time. He reiterates this, okay? So he's harping on that. Now, we're going to hear from him in just a moment, but before we continue with this, I want you to take a look at this chart. Now, you can see this is from the Fed. It's showing you how in environments where we've seen interest rates starting to rise, we also have seen a corresponding increase in unemployment. Okay, so the unemployment is kind of it lags behind the interest rate hike. So we know what we can expect to see here in the not too distant future. Now, let's continue on. He's got one other big time important statement here that he makes. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. So he's saying, prepare, guys, because what we've done so far hasn't done what we wanted, hasn't resulted in what we wanted to see. So you ain't seen nothing yet. That's basically what he's saying. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring down inflation. Makes sense to moderate the pace of rate increases. So he's not saying that they're going to eliminate them. The time for moderating the pace of rate increases may come as soon as the December meeting. Again, moderate, not eliminate. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation. So he's saying it's not a matter of how much rates will be raised by, but how long we will be in an environment where we'll be needing to raise rates, okay? That says to me, we're looking at like 2024 before we can start to see a light at the end of the tunnel that is not a train. It is likely that restoring price stability will require holding policy at a restrictive level for some time. Again, I just said 2024 is what I think will be the reverse of the trend of rising interest rate. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done. All right, so that's pretty clear. Now, let's hear from Fed Chair Powell in his own words. Now, we just went through what he wrote, but let's see some of the flavor of it in terms of his actual live statement to I believe it's the Brookings Institute.
The relationship between job openings and unemployment is a very fraught one. And job openings right now, compared to unemployment, are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that'll work.
So there you go. It's saying that, look, this is what we've seen. We looked at the chart. We know what he's talking about. Increased unemployment as that interest rate ticks up. And based on his written comments that we just went over, he has no intention of reversing course in terms of rising interest rates in the near term. We will stay the course until the job is done. Those are his words. All right, so basically he's saying, there is a chance that we might see a smaller amount of jobs lost, but notice that he didn't preclude that would happen. I mean, he can't, right? Is it wishful thinking to say that will occur, that the amount of job losses will be smaller? Well, I don't know, and I hope he's right. Okay, I don't want to see people lose jobs. I certainly hope he's right on that. All right, so it remains to be seen what exactly will occur. We will keep our eye on it, but in the meantime, please act as if. All right, now we are sailing into, there's some clouds on the horizon. I just saw a bolt of lightning come down over there. Listen, close the hatches, okay? Bring in the sail, okay? Prepare for rough water. Change your habits and start to act as if you may have to tighten the belt. Whether you be an employer and you may have to make do with fewer employees, or if you are someone who is employed and you might lose your job. Sit down and just think about that. What would I do if I lost my job? What would we need to cut back on temporarily? This is why I always stress, guys, you got to build multiple streams of income, because it's just like having a spare tire in the trunk or in the boot for our friends in the UK. If you have a failure in one, you have some redundancy, okay, that will keep you moving down the road toward what? Financial independence. Because even though all of this is going on, we got to stay nimble and we got to stay on that road to financial independence. All right, speaking of financial independence, watch this video. One of the major financial institutions is offering a 401k in something you would not believe. Okay, is this a good idea, or is this going to cause that financial boat of yours to capsize? Check the video out, guys. I'll talk to you soon.